Hello and welcome back to Managerial Accounting. This is Chapter 2, Cost Terms, Concepts, and Classification. So we're really going to go and provide some more groundwork, lay some foundation, insert favorite building metaphor here. So continuation from last week, which is kind of like, what are we doing here? And this is the building blocks for how are we going to do it. As always, thank you so much, Ruth Ann, for these base, and I've edited them. This is a decent amount of edits, but really solid base, so thank you for helping us keep the language consistent with your book and quizzes. In these series of videos, we'll be covering a number of learning objectives. As you can see in our course syllabi, all of the learning objectives for this chapter are examinable, are important to know. So we'll start off with kind of a broad overview. We'll dig into some mechanics. We'll get out our journal entries. We'll see Excel or whatever the Google that thing is, Google Sheets. And we will kind of go through, and then we'll end off with my favorite, really one of my favorite topics, which is like, how do we actually use this stuff? Differential costs. When do these costs matter? When do they not matter? How does this go into items that we are going to be using for calculations going forward, such as opportunity costs, which you may or may not have heard if you've taken econ before. Hopefully you've heard if you've taken econ, as well as sunk costs. So we get to circle back to some of those behavioral items because, well, it's, we'll talk about the definitions of opportunity costs and sunk costs, but then it's like the psychology of actually applying it and thinking in your own mind about it. For example, what if you took a course, you signed up for a course in the fall, and you bought a textbook, and then you're like right before the drop date, so you get all your money back for the course, except you have the textbook, and you can't get a refund for it. There's a bazillion versions of the textbook out there, so you probably can't sell it, or you probably can't sell it for much. Is that a sunk cost? I mean, possibly. And is it easy? Is it like an easy thing? Because you've already spent the money and you're like, well, gosh darn it, I have the gym membership. I may as well go to the gym and make it worth it. I have the textbook. I may as well stay on the course and make it worth it. Is that technically, with the information that you have available now, the best decision? I don't know. So those are the types of things that we will be looking at. Of course, we'll look at it in a business context, but these concepts very much apply in your own life. And I'm going to tell you a few stories. Please, it is a judgment-free zone about how sunk costs and opportunity costs have entered into my own life. Okay, so without further ado, we are going to smash out 2 learning objectives in this one video. We will be looking at the 3 basic manufacturing costs categories. And then we're going to look at how do we distinguish between what is a product cost and what is a period cost, and why does this matter? Okay, so not this morning, but a lot of mornings, you will see me if you, peer into my office, peer into the space. I actually have a cup of coffee in front of me right now, although it is one I made at home. But if we take a look at Tim Hortons coffee, maybe you are drinking one right now. If so, let me know. That would be kind of funny. So look at your coffee, inspect your coffee, inspect your favorite beverage, and what do you see? You will see a cup, you will see liquid, and you might see some beans that went into making the cup. There was probably, if somebody made you the coffee, so you bought it from Tim Hortons, somebody was pouring the coffee, somebody had to put the beans in the machine, press the button to make it kind of go. Somebody took your order, somebody got your money, and you walked into an establishment even before then, and there were lights on. Maybe you used the facilities, that is the washroom, and so somebody paid for those facilities for you to use. So, how do we cost this? And by the way, we care. Big story, because if we don't know what things cost, people don't know what to charge you, and then people don't know if they're going to actually make money. Is there going to be a margin between what they charge you and what it actually costs to provide you? Because at the end of the day, we want a for-profit company to make profit and provide a return to the shareholders, be able to satisfy their debt. So we do see some continuity with that one bucket of data going back to our external users. However, what we need to do as management is actually determine, are we going to charge people more than it actually costs? So direct materials. What goes directly into this coffee? Well, It's going to be beans, water, and whatever paper cup, and I guess maybe there'd be some glue in there. So the supplies for the cup and the supplies for the coffee, those are our direct materials. Direct materials are materials that by definition go into the final product. Those are raw materials, and the raw materials may have some direct and indirect materials. Perhaps you got a receipt, you're not consuming the receipt, but yet the receipt was part of the coffee transaction. So probably consider that an indirect material. Direct materials are materials that are an integral part of the product and be physically and conveniently traced to it. Indirect materials can either not be traced or it's not worth the expense. Like, are you really going to count every single, 1/1000th of a receipt printout and like the 0.002 cents of ink? Like, you could, and if it's material to you, sure. But in general, you have to use that professional judgment and say, okay, coffee, maybe water, depending on how material it is. So coffee beans, hot water, and coffee cup definitely are the biggies for direct materials. Now, same thing with direct labor. Direct labor consists of labor costs that can be easily traced to the individual units of product. Okay, so what is easily traced? Well, I would say if you have one person on a coffee station and another person on the sandwich station, then you could probably add up all the cups of coffee that were poured and, look at the number of hours and the wages paid to that coffee person pouring, and do the same for the sandwiches. And that's direct labor. However, you then have the labor of the cashier, and the cashier is not just bringing in coffee. They are bringing in coffee and sandwiches and donuts. Maybe they're getting the donuts, and then, that's not easily traceable. So I would say that the cashier for a full service Tim Hortons would be an example of indirect labor, and we'll talk about what to do with indirect labor and indirect materials right now. For the present time, I do want to, talk about direct materials and direct labor. The key here is that they're easily traceable to the individual units of product. And that easily traceable is going to be some professional judgment. That's going to be getting in, thinking about it, applying it, thinking what is the best answer, knowing that, you probably could argue for all the answers, but it's like, really, what does it make sense in the context of the business? Okay, so if it has to do with the product, but it's not easily traceable, that is, it's a direct material that's not easily traceable, it's like a receipt, or it's labor that is not easily traceable to the cup of coffee, that, for example, the cashier, we're going to put it into the manufacturing overhead bucket. Manufacturing overhead, by definition, are all the costs of manufacturing other than direct materials and direct labor, so it's kind of like our other bucket, that include indirect materials, indirect labor. They'll also include things like utilities, so all of the lights, the utility costs of that Tim Hortons, because somebody has to pay for the lights, the lease on the building, maintenance for the washrooms. Like, these are all things that cannot be easily tied back to the individual cup of coffee or individual sandwich. So they go in the other bucket, which is the manufacturing overhead. They're costs that are incurred as a part of doing business to produce the coffee, but are just not easily traceable. Put in the other bucket, and then in a future chapter, we'll talk about really what to do with that other bucket to make sure that every cup of coffee, every sandwich gets their fair share of the other bucket, plus the direct materials and direct labor. So we know exactly what this cup of coffee actually costs. So we can see if the $2.14 or whatever it is in where you are and what size you are, you kind of know, are we making money off of this cup of coffee? If we're not making money off of it, then it means that our other products are subsidizing it, which is another potential problem. So the more you know. Okay, boom. We all love a good visual, so I like to have a little talk and then see what this actually looks like. So we're going to have our manufacturing costs, because we are in Tim Hortons. We are in the business of manufacturing a cup of coffee. We either have the coffee pourer, salary. We have the coffee beans and the cups, and these are referred to as our prime costs. Then we have our direct labor and our manufacturing overhead that convert our prime costs, which are called conversion costs. So the direct labor helps us turn, they press the button and they make the beans plus the water turn into the coffee. They pour the coffee and they help convert our direct materials into that product. Same thing with the rent, with the utilities, with all the other product costs that help convert those raw materials into our final product. Okay, so we just talked, I'm going to go forward. We just talked a lot about this cup of coffee and that it's a product cost. We also have non-manufacturing costs. So I had to go to Wikipedia. I didn't want to just steal this to not steal this. But we have our non-manufacturing costs. So Tim Hortons headquarter, they probably have coffee there, but I doubt there's like a full out, and it's definitely not available to the public, definitely not available for sale. They're not selling coffee here. There's no sandwiches here. Boston creams, unlikely. Timbits, there's no donut. Is there a Timbit? I don't know. Not to get too existential on you here. Okay, but this is a price of doing business, right? You have a bazillion Tim Hortons everywhere. You're going to need a head office. At least in today's day and age, to oversee all of those individual franchisees and corporate stores. Okay, so this costs money, but it's not a product cost because it's not like directly or indirectly related to that cup of coffee. It's part of doing business, but it's not a product cost. So if it's not a product cost, if it's a non-manufacturing cost, this is referred to as a marketing or selling cost or administrative cost. Apologies when I've converted to Google. This happens. Don't love this. So these are also referred to as period costs. So we have our product costs for the coffee, etc. And then we have our period costs, kind of like the supporting cast for our head office, etc. All the marketing that you see on behalf of the franchisees, boom, period cost. Any selling costs, for example, if we paid a commission for somebody who, sold a new franchise somewhere, established a new franchise, that would be going into here, a period cost. Administrative costs, so, being a publicly traded entity, then any audit costs, any listing costs, any legal costs that are, high level to all of the Tim Hortons. Administrative costs. I hinted already that these are period costs and that the manufacturing costs are product costs. This will make sense in the next slide once we put it together. If you like visuals, I am a big fan of screenshotting some things, so this would help me kind of create that mind map. Okay, so we have our product costs. That's our coffee. Coffee cup, coffee cream, coffee sugar, I guess just sugar. Isn't that weird? Coffee cream is referred to as coffee cream, but sugar is just like sugar. Anyways, so we have our coffee. Once we have our, say, donut inventory, our sandwich inventory, we have our coffee that's not yet brewed, etc. All of this goes into our inventory. And once it's sold, boom, it goes to our cost of goods sold, which you would recall from our intro financial accounting. Okay, so that's what we do with our product costs. Then we have our period costs, which are our head office costs, the lease on that building that we saw in the last slide, our CFO costs, our CEO costs, all of our like executive costs, management that's not directly dealing with the stores in the stores, our selling costs, our administrative costs. All of these are referred to, all these non-manufacturing costs are referred to as period costs and are expensed immediately on the income statement. So the difference between the two is that product costs are inventoried and when sold, go to cost of goods sold. However, non-manufacturing costs are also referred to as period costs and they are expensed when incurred. Things like head office lease costs, utilities on the head office, and executive payroll compensation. Okay. So a quick check, which also acts as our last part of this video. So which of the following would be considered a period cost in a manufacturing company? Choose as many as apply, and I'll give you a hint. We have two here that are the best answers for period cost. So give this video a pause, see which two you can come up with, and then I will meet you back here. All right, so if you said B and E, you are correct. Although there were some other tricky ones that came into play. So let's go through each one until hopefully we're all on the same page. And if not, please post to the discussion board in the comments. Happy to have a conversation. See us in office hours. See our wonderful TAs, Bishu or Bree. Book an appointment with me. See you, Tian, if you want to chat about this further. Okay. So which of the following would be considered a period cost, aka a non-manufacturing cost? Okay, well, we have manufacturing equipment depreciation. And this one might be tempting because you're like, well, depreciation, that's not directly tied to a product. However, because it's manufacturing equipment, it's, I guess manufacturing equipment, maybe that's like part of the thing that technically would grind the coffee grounds, right? So the beans come in the bean thing and the bean bag, and then it needs to be ground. So that would technically be, the grinder would be the manufacturing equipment. And while it's not easily tied to the product, it does have to do with the product. So it's not a direct material, but it would be part of that other bucket, that manufacturing overhead. So this is going to be a product cost and therefore not part of our period cost here. Property taxes on corporate headquarters. Corporate headquarters. Aha! It's a period cost because it's going to be related to all the products. It has to do with the general, running of the business. Nothing tied directly to a product. Therefore, it's going to be a period cost and expensed immediately. Okay. Direct material costs. Okay, this has to do directly with the product as such. It's a product cost, not a period cost. Electrical costs, maybe, to light the production facility. Production, producing the products. Okay, so this isn't going to be, easily tied to a product, but just like our manufacturing equipment depreciation, it's going to be part of that other bucket, that manufacturing overhead. Okay, so a product cost, just like A. All right. And then we have sales commission. So this would be something like the sales commission, perhaps on issuing a new franchisee. This is part of selling general and admin, which has to do with all of the company. And this is going to be a period cost and expensed immediately on our income statement. Awesome. Well, this video is getting to the length of kind of where I like these videos to be on the upper end. So thank you so much for your attention, and I will see you in the next video.